Hello, everybody. My name is Jeff Fowler. I'm with the Apartment Owners Association. It's great to have you with us again. So wish we could be in person right now, and but we're kind of getting used to this, not getting in the car and fighting through traffic. Anyway, yeah. So AOA is one of the largest individually organized groups of apartment owners in the state. And our goal is to help you make or keep more money. We want to give you ideas, just even one idea that'll help you make and or keep more money and make it easier for you to manage your rentals. And today we're going to have a live stream about the 1031 exchange. And before we get started, just want to mention that if you would like to see closed captions, you can do that on the Facebook page of AOA. And so you could go head over there now if you would like to see closed captions while it's live. If you're watching this after the fact, I believe that even YouTube will have closed captions for you. And anyway, one thing I do want to highlight about AOA is that we do have a brokerage. And actually, the brokerage was in business before the association was. And for all of you, we will give you a free property valuation if you're considering to sell your building. And it's very comprehensive. Everyone in our office has over 25 years experience, and we'll set you up and help you with that. And do want to mention, wow, last week Franco Simone did such a great job with how to prepare for small claims court and went through everything, and it was applicable to the whole state, everything that he talked about. Yet he spoke specifically from San Diego and mentioned the San Diego thing, so that was great. And then we really need to repeal this death tax that got slipped by on us last year. And so the Howard Jarvis Taxpayers Foundation will speak, I believe, next week. And yeah, we'll speak on the 18th. And so you'll want to hear him and learn how we can all get involved in helping repeal that and why that's important. So all this, we're going to continue to bring you content that will help you just give you those ideas to make and or keep more money than ever before. And so subscribe on YouTube or subscribe to the newsletter, because when you subscribe to the newsletter, then you get it for free. Plus you're registered, and lots of times after an event, we will send slides or something else, some resource to the people that did register. So if you register for events, that'll help you a little bit. And yeah, and then today, as the presentation goes on, if there's a question that you have, go ahead and as they speak and they say something that you didn't quite understand, or that it created a question in your own mind, go ahead and put that in the chat. If you're on AOAUSA.com website, there's the blue help button. If you click on that and type in the question, we'll get that question will get funneled over to me, and then we'll be able to ask it. So all that before we get started. And yeah, so our sponsor today is Real Estate Transition Solutions. And so those of you that are maybe at the right time to transition from active management to a more passive role, they have solutions for you. They're a real estate advisory firm. They do about $220 million per year, and they're located on the West Coast. They do have an office in San Francisco, but they're active all throughout the states. So no matter where you're at, they can help you. Our speaker today, he's a partner in Real Estate Transition Solutions. He's a guy that grew up with investment real estate, so he knows the industry well. And he worked at PwC, which is a one of the big 5 accounting firms before he came on with them. And anyway, you'll really enjoy our speaker today. Let me introduce him to you, Austin Bowlin.
All right, Jeff, appreciate the introduction there. So as Jeff mentioned, my name is Austin Bowlin. I'm a partner at Real Estate Transition Solutions. We've done a number of webinar presentations with AOA and really appreciate the opportunity to share some educational content with investment property owners in California, especially. So today, what we're going to be focusing on is an overview of some of the tax reform proposals and looking forward as to in 2022, what we expect to actually take effect as it relates to tax changes. This is a subject that we've received quite a few questions about over the last 9 months, as you'd expect with the change in the White House administration. So it's difficult to know with complete certainty as to what changes will end up transpiring, and there is still plenty of negotiation to be had in the coming months. But based off where we stand today, as of early November, that's what we're going to discuss moving forward. We'll touch on in brief a 1031 exchange replacement property option that's referred to as the Delaware Statutory Trust. In order to invest in Delaware Statutory Trust replacement property, you must be what is considered an accredited investor, meaning having a net worth in excess of $1 million, not including the value of your primary residence. Or alternatively, you can be defined as accredited through a number of other criteria, such as annual income in excess of $200,000 if an individual, $300,000 if married filing jointly. Also by holding professional certifications such as a CFA or various licenses like securities licenses. Before we get into the meat and potatoes, a little bit about our firm, Real Estate Transition Solutions. We are a real estate advisory firm that focuses on serving property owners who are navigating what we consider the transition from the third to the fourth quarter of property ownership. This is a period of life in which often a property owner is starting to think differently about their properties than they may have 10, 20, 30 years ago, placing perhaps a greater emphasis on stable, predictable income, enhancing income often, looking to either reduce or outright eliminate an effort spent managing properties, looking for more passive ownership structures at that point. Of course, looking at options and ways taxes can be mitigated as best as possible, given that in all likelihood, if someone has owned property, investment real estate, especially in a number of California markets, you experience substantial appreciation over the years or decades of ownership. So those tax consequences can be significant as a result. Also starting to place a greater emphasis on estate planning implications and how do we transition these properties to beneficiaries, ideally without forcing a co-ownership arrangement, knowing that there are significant tax benefits associated with owning real estate until one passes away, especially when in a community property state such as California. So much of the work that we do centers around working with property owners to analyze their properties, understand what their objectives are. If there ends up being a gap between their objectives and the properties that they own, then providing transition strategies and recommendations to then reposition their investment real estate into something that is going to be more reflective of their objectives for that upcoming chapter of life. The firm was founded by my father, Roger Bowlin. He began his career in commercial real estate brokerage and then had a few decades of experience in more traditional wealth management. And that was really a key time as it relates to taking that financial planning lens and applying it to the context of investment real estate. I joined the firm 5 years ago, partner at the firm in CPA, do much of the tax strategy work. And we have a team of advisors that work with property owners, all of which are very good at dialoguing with an owner to understand what it is that they're seeking to accomplish. Also have a client concierge team, operations team, marketing team that produces a significant amount of educational content as well. So what we're going to touch on today is talking through a number of the proposals that have occurred at various points in the last, call it 16, 18 months, and where they stand today in terms of likelihood. And then what we're going to do is we're going to marry those proposals with recommendations or strategies, rather, that would be able to address possible changes. We'll also classify those proposals as to the likelihood of occurrence from our vantage point right now. We're going to open things up with a quick overview, no more than a minute or two, of 1031 exchanges to have that background context, because this is really looking at tax changes within the context of investment real estate. And 1031 is a focal point of that. And then we'll talk about some additional resources available for further learning, and then open it up to Q&A following. So the 1031 exchange is a section of the tax code, section 1031 specifically, that's been codified, part of the tax code for, at this point, as of 2021, 100 years. So it's a big misnomer when people will refer to 1031 exchanges as a loophole, when one, it is very much in the tax code. It's named after the section of the tax code. And two, it's not like it's a new change. It's been around for a century at this point. What it allows for is, if adhering to certain rules that the IRS has put forward, it allows for an individual or an entity to sell investment real estate and perform an exchange in order to defer all of the tax that would otherwise be due upon the sale of that property. Now, that deferral, some will say, is temporary, which technically it is. But for many, the plan would be to continue executing exchanges over the years of ownership, decades of ownership, repositioning investment property so that it meets their objectives all the way up until the point in which an owner passes away. And then a concept that's referred to as a step up in basis kicks in. And what that means is, at that point, upon the passing of an owner, in California as a community property state, it could be, if it's a married couple, either spouse. Upon the passing of an owner, then you have a full step up in basis, and all of that deferred capital gain, depreciation recapture, net investment income tax is then eliminated. So for many, the question then becomes, well, if we see the benefit of continuing to own until we pass away, what type of ownership, what location, what property type, what form of ownership structure is going to be most in line with what we are trying to accomplish now at this chapter, given the years, the age that we are, and what our financial and lifestyle objectives are. A lot of individuals will think that the allowable replacement property with exchanges is fairly narrow. If you sell a single family rental, you need to exchange into a rental, or if you sell agricultural land into agricultural land, but it's actually quite broad. So the IRS uses the term like kind, and they're not looking at property types when evaluating whether a property is like kind, but instead the intent as to why that property is owned. So anything that is held for business or investment purposes is like kind to any other property held for business or investment purposes. And that really is going to be inclusive of all real estate, with the exception of primary residences and personal use property. So what we have, starting in, call it early 2020, when the presidential campaigning really started to ramp up, are a number of proposals that were floated, and then some of which had more structure put behind them and caught a little bit more momentum. And then, as we all know, President Biden took office in January. There's been plenty of congressional negotiations since that point. Tax reform has been on the docket, which is somewhat surprising given that previously the cadence for substantial tax reform in Congress was once every, say, 10 to 15 years. And we just had a comprehensive tax bill pushed through in 2017, Tax Cuts and Jobs Act. That's part of the reason why we probably haven't seen the headway made that individuals on the left side of the aisle would have preferred to see. But there have been a number of proposals, and there has been ongoing dialogue. What it started out with on the campaign trail, and it's important to note that this is a proposal that was made on the campaign trail, meaning that there very well could be little to no substance behind it, was to outright eliminate 1031 exchanges. The next proposal was not to eliminate, but rather to limit 1031 exchanges. There's been a proposal to increase capital gains rates There's been a proposal to decrease or actually outright eliminate the step up in basis, that concept that I was referring to earlier of when someone passes away, then there's that step up in the capital gains, depreciation, recapture, and net investment income tax are eliminated. So there's a proposal to take that away. And then there's a proposal to reduce the federal estate tax exemption amount as well. What we're going to do is we're going to walk through which of these proposals we feel like are likely to occur, and various strategies that could be used to address any potential changes, including those that we consider unlikely at this point. So the first likely change, and we'll work from likely to unlikely, the first likely change that we expect to see occur is going to be an increase in the capital gains rate. Currently, at the federal level, the capital gains rate is 20%. That's the highest rate that can be applied to long-term capital gains. On top of that, of course, can be your state tax, up to 13.3% in California as well. And then also net investment income tax, which is an additional 3.8% tax. We expect there to be an increase from 20 to 25% for the long-term capital gains rate. And I know that there has been some resistance from individuals such as Christina Semina and Joe Manchin that are Democratic senators that are saying they do not want to see an increase in tax rates or an increase specifically to the capital gains rate. But it's going to be very difficult to fund any of the proposals put forward by the administration without having some substantial tax increases. And 5% may be approaching the point in which it doesn't quite disincentivize investment, given the fact that we're likely to see the overall ordinary income tax rate, the highest rate to increase pretty much about 2% across the board for all graduated brackets, but that would move us from 37 rather than 39% federally. If we do see the capital gains rate increase, that just makes the 1031 exchange all the more meaningful. So the strategy to address that would be consider and continue to execute 1031 exchanges when repositioning investment real estate, given that the tax that you will be deferring via 1031 exchange will be larger with those higher rates. The next proposal that's been discussed that we feel like is likely is going to be the reduction in the federal estate tax exemption amount. Without going too deep into the weeds here, the reason why there is a concept of a step up in basis upon the passing away of an owner, so eliminating capital gains, depreciation, recapture, net investment income tax, is because the federal government would rather take federal estate tax, can be as high as 40%, then apply those 20 and 25% tax rates to capital gains. And they really can't do both. You can't have an appreciated asset and tax it at capital gains and then turn around and tax it at 40% for estate tax without any sort of transaction occurring, just an owner passing away and passing it down to, say, for instance, a child or niece or nephew. So what the government said is, well, let's give that step up. Let's get rid of the capital gains and let's take the federal estate tax instead. But we're going to allow an exemption up to a certain size of the estate where no assets or dollars transition down to beneficiaries would be subject to that estate tax. Currently, where we stand today is that exemption amount is $11.7 million per individual. So if you are, again, a married couple, we're talking about a pretty substantial amount of money that can be moved, or assets that can be moved down to beneficiaries, about $23.4 million at that point. What the Biden administration has proposed is to reduce that number from 11.7 to a smaller amount. We haven't heard explicitly what that's about or what that amount will be, but many have projected that it'll likely be around half of the current exemption amount. Now, this is a change that I don't think should really startle anyone, in the sense that the federal exemption amount is a figure that changes year by year depending on who's in office and how far into office they are. During Bush 43, we actually saw it sunset, meaning that there was no exemption amount. It was unlimited, could be passed down to beneficiaries in a given year. And then we've seen it reduce substantially during the Obama administration, go back up during the Trump administration, and then come back down likely is what we'll see in the Biden administration. If you have a state that is over that exemption amount, either where it stands today or where it could be next year, what we recommend then is looking at ways in which you can reduce your estate value from an estate tax standpoint. And one of the ways you can do so is the Delaware Statutory Trust Replacement Property. It can employ a concept referred to as a discount for lack of control. So by selling, say, a $10 million multifamily property and exchanging that into Delaware Statutory Trust Replacement Property, say for $10 million, and now you own, instead of 100% of a $10 million building, you now may own, let's say, 15% of, or let's say 10% of a $100 million building. At that point, you have a non-controlling interest in that building. So when the IRS looks at your estate value, they may take that $10 million property and say, we actually think it's worth closer to $7 million for estate valuation purposes, in order to capture the fact that you don't control that property. You're a passive silent investor in that property. So that's one strategy to reduce your estate value on paper, even though your underlying investment is still really worth $10 million. Alternatively, you can break ownership up that you have today and gift small amounts to, say, family members, for instance, and start reducing your ownership that way as well. Now, that gifting would count against your lifetime giving exclusion, which is the same as the federal exemption amount. But if you put yourself in a position where you have a non-controlling interest, say 49% ownership, then that can help to reduce the value for estate planning purposes. Now, when looking at looks like I was muted there for a second. So when looking at the lower level of likelihood, we have the possible change of limitations on 1031 exchanges. What was talked about here was reducing the amount of allowable tax deferral down to $500,000 per individual or $1 million per couple. We don't see that. That's not in the language any longer. House Democrats came forward with their tax reform proposal in early October, and there was nothing that spoke to 1031 exchanges there. So we feel confident that we'll be out of the woods here. But if that does occur, what we would recommend to do is to sell properties in the near term and exchange them into smaller properties or fractional ownership like the Delaware Statutory Trust, but divide your sales proceeds among multiple different properties or investments, such that then when those properties eventually sell, you have smaller transactions with, say, less than $1 million of gain embedded in each of those individual properties. So that's certainly a strategy that would help to address it. Then we have the outright elimination of 1031 exchanges, which we feel like is very unlikely at this point. But if that were to surface again, rear its head, then what you would strongly want to consider doing is either not selling the property and just continuing to hold it into perpetuity, which may not be a fit for many investors, or sell and exchange into property that's going to then be able to participate in what's called a 721 UPREIT. So the Delaware Statutory Trust is a fit here because that property can then be absorbed by a large REIT and then in turn give REIT shares for the ownership of that property. That's a relatively complex concept that we'll talk more about in additional webinars. Now, lastly, if exchanges are outright eliminated, you could also look at an installment sale, spreading out your capital gains over multiple years. You're going to incur some interest expense and have to pay ordinary income tax on that interest as well. But that's another option as a tax deferral strategy should exchanges be eliminated, which again, we don't think is really even on the table at this point. I touched on the Delaware Statutory Trust as a way to address a number of these various strategies and utilize it as a tool for exchange purposes. And what that is a form of fractional ownership, where you can exchange into owning a 1% or 5% interest in a large, high quality institutional property, the likes of properties that you typically see being acquired by REITs, pension plans, university endowments, and so on and so forth. We have a number of webinars and content on our website that speak to the Delaware Statutory Trust structure. So I'd very much encourage you to join for one of those webinars or review some of those materials. But in brief, there's a number of attributes and benefits associated with Delaware Statutory Trust ownership that makes it a replacement property option worth being familiar with and knowing as you're doing your long-term planning and looking out of what would be the suitable replacement property for you if your properties today do not fit with your objectives. If you're interested in seeing illustrated properties or currently available properties that have made it through our firm's due diligence process, would very much encourage you to visit our AOA member portal or hub, and that is re-transition/AOA. There we've worked to really distill down the content and make sure that it's applicable to California apartment owners. That way all the tax rates apply, any sort of regulatory references are within the context of California. But great resource to draw upon. There you'll also be able to schedule a consultation with one of our exchange advisors if you're interested in having a conversation with them. 2 guides are available on our website as well. Our guide to understanding 1031 exchanges and our guide to investing in Delaware statutory trusts, both of which can be found on the site, as well as our list of upcoming webinars that will typically be about an hour. So we have a little more time to dig into the materials, but we'll focus on various other exchange related concepts. And lastly, here is that site for those who may be interested in visiting it. It is re-transition.com/AOA. So with that, I'm going to hand it back over to Jeff so that we can start fielding some questions.
Great. Thank you so much for that update and going through each of those potential changes. And
you bet.
Yeah, so that's kind of cool that you did that. Thank you so much. And for all of us, we're going to have our first commercial right now. While we do a commercial, I want you guys to type in your questions, and hopefully on the back side of it, we'll have some questions for Austin to answer. And here we go.
We've been partnered with AOA now for some years to bring our ratio utility billing services to membership. And what really sets us apart, aside from quality service and taking great care of your residents and billing them back fairly and accurately for their fair share of utilities, is that we have no minimums. So that means if you've got a duplex or a single family home with an ADU, we're happy to help facilitate the utility bill back on your behalf. So we would love for you to get in touch and join all of these happy customers in using our service and celebrating conservation, but also increasing your net operating income. Livable.com/AOA is where you can find more information and ways to get in touch with us. Look forward to getting some time scheduled and to telling you more about the program and how you can do your part to promote conservation. All the best and enjoy the live stream.
All right. Well, there you go. Hope you enjoyed that. And we got questions are starting to flow in, so that's good. Give us a little time. One thing that I did forget to mention to you is that if you are an AOA member or if you're thinking of joining, now really is a good time, because starting January 1st, the price for the membership will increase. And so if you're a current member, you can tack on to your membership 1, 2, or 3 years. And if you want to sign up, you can also sign up, and you can go to aoausa.com and hit the join button, and everything will work out for you, or you can call in. So either way, and just wanted to let you know about that. But let's go ahead and get to a couple of the questions that we have here. And again, we're keeping the questions limited to 1031 exchange. Austin is not well, I guess you work for Price Cooper Waterhouse, so you probably could
Price
answer.
Waterhouse. Price
Price
Waterhouse.
Waterhouse Cooper, I mean, yeah.
Yep,
So,
yep.
so you probably could answer some tax questions, but that's not what we're here for so much. So let's see what we have. 1031 exchange questions. Here it is on YouTube. Farshid, do you provide exchange accommodator services?
We are asked that question all the time, and understandably so, because we provide a lot of content about 1031 exchanges and exchange strategies. Unfortunately, we do not serve as a qualified intermediary or exchange accommodator, exchange facilitator. All three are terms that you'll hear that are synonymous with one another. Because the IRS requires that the accommodator be what they call a disinterested third party. So as soon as we start to provide recommendations, talk about objectives, then we're precluded from serving in that role. That being said, we have worked with probably every major qualified intermediary on the West Coast at this point. We execute about 300 exchanges a year on behalf of our clients. So if you need a qualified intermediary, happy to provide an introduction to you.
Great. And here's Patricia. How likely do you think it is that the step up in basis will be eliminated?
I think it is very unlikely that it'll be outright eliminated. I think we'll see the exemption amount come down. So you will have a state tax over a certain amount if your state is sufficiently large, but not outright eliminated. And in part because, yes, we're talking about tax reform and funding bills that have been proposed, but we're also talking about politics here. These are elected officials. And if you turn something on its head, like the step up in basis, that the baby boomers, who are a massive voting bloc, have really built a lot of their financial planning and wealth management strategies around, that's going to cause quite a bit of frustration and resentment among those voters. So that in and of itself probably would preclude it from happening.
Great. And I just have a question for you. All of our members have really built a legacy, or they're in the process of building a legacy on multifamily housing, or at least rentals. Mm-hmm. And so when they sell their property, they're ready to transition to a more passive role. And if they were to sell their property, do you have, there's a lot of different diversification, in different types of property. And they some of them will be interested in that, but a lot of them want to stick with what worked for them possibly. And, it's kind of a business decision for them, but I'm just curious, do you have options for them that are strictly multifamily housing?
Oh, absolutely. I would say easily 50-60% of the property that we work with in the Delaware statutory trust structure is going to be multifamily property. And there's a number of reasons for that. Certainly the familiarity with the investor to that property type is helpful. That's really not the primary motivation behind it, though. The primary motivation is that it's an essential property type. Americans are renting longer, homeownership is more expensive, and it is a hedge against inflation. And you have the cheapest capital out there in terms of debt on multifamily because it's subsidized by the federal government. And you see the ability to add value to these properties as well. There's more management opportunity with those properties. Now, if you're an owner today of multifamily, that management very well feels like a burden, but it does create investment opportunity as well. Right. So we're big proponents of multifamily.
Okay, on YouTube, Starcatcher, how do DSTs do in a down economy?
I mean, I think all real estate can be impacted by recessions. Some recessions, like the Great Recession, are significantly more targeted to certain sectors like real estate and like finance than comparing that to, say, for instance, COVID. The recession that we started experiencing in 2020 and through 2021, beginning of, that really did not meaningfully impact any of the Delaware statutory trust properties that we were working with the exception of a few properties in certain markets where the COVID response was, shall we say, less than strategic and seem very much reactionary, like Seattle, for that matter, where we are located, or at least where I'm located. So, real estate will go through cycles. That's inevitable. I think there's a strong case to be made for the institutional quality properties being more stable and predictable, just given who the buyer profile of these properties is and how long-term of a investment lens they're taking. But it's not without risk, right? We're not buying US Treasuries here. And it's an asset class that does have some risk associated with it.
All right, Jill on YouTube. Do you ever deal in SFRs?
Regularly. We have clients who are selling single family rentals all the time.
Okay. And what about on the other side? Do you have any deals that include single family residences?
No, that's a relatively new phenomena within institutional real estate to be actually investing in single families. So you're seeing there's Vinebrook and BlackRock has a fund and Carlisle has a fund that are buying thousands and thousands of single family homes. Or even now we're starting to see more communities like the Christopher Todd is a developer who built purpose-built single family rentals. More think casita style and often Arizona and Florida. And that's a relatively new trend. We do work with the purpose-built single family in the Delaware Statutory Trust because those are largely communities that are built with say 200-300 homes in it and it really operates as a multifamily property would. These portfolios of 3,000, 4,000, 5,000 homes that are spread out all over the country and often largely focused in the Midwest. We're not working with those currently. It's not to say we wouldn't down the road, but I think you really have to have your management dialed in order to operate a portfolio of that scale.
All right. Okay, on YouTube, Reverend Enjoy in Alameda. What is the usual return on investment with a DST per year?
Depends on the property type, and the return's always going to be comprised of two components. You have income on one hand, and then you have appreciation potential on the other. So, we're seeing income ranging anywhere from say 4 to 6% within the properties that make it through our due diligence process. And I say that because I'm sure there are higher returns that can be pursued out there, but not with a risk profile in which we're comfortable with, and most of our clients are comfortable with as well. So that's the income side. On the appreciation side, again, depends on the property type. But typically we're looking at historically somewhere in that 1.5 annually to say 6 or 7% annually. So we're usually targeting high single, low double-digit annual returns when adding those two together.
Great. All right, Megan on YouTube. How long do you recommend seasoning a 1031 exchange property before you change the ownership?
So if you've exchanged into a property, as that question suggests, and then you're going to change ownership, many would say there's no seasoning requirement there. You can do that immediately after. You don't want it to be in process while you're executing the exchange. But many will say that the nanosecond rule applies. As soon as you've completed your exchange, you've acquired your replacement property, you can change ownership at that point. On the other side, if you were to flip that transaction over and you were to have a legal entity change with an exchange to follow, a sale and exchange to follow, there's no bright line here, but if you're a California taxpayer and property is located in California, you're going to want to likely wait at least 12 months between the date in which you change the legal entity to when you begin selling the property. And some tax preparers would even say 2 years.
Yeah.
But it depends on a number of things, like if you have debt on the property, size of the property certainly as well.
Great. Okay, Farshid. Are there any benefits in owning RE investments in LLCs in terms of the 1031 exchange proposed tax changes?
No. I mean, other than being able to gift ownership a little bit easier if you're trying to break apart your ownership, but really not any substantial tax benefits. They're pass-through entities. The LLC is, so you're going to be taxed the same as if you're an individual. But it does give a little clearer path towards gifting membership interests.
Great. Okay, on YouTube, we have C. Lou. Do you have information or deal with 1031 exchange with opportunity zone investments?
No, we don't exchange opportunity zone investments. We have recommended a number of opportunity zone investments, but it tends not to be a popular option with property owners because they have the 1031 exchange available to them. If you're selling stock or a small business or something to that effect, great. That's one of your few tax deferral strategies that you have. But for those that have the 1031 exchange, especially a 1031 exchange with significant depreciation recapture in their property, then very, very rarely do the benefits of the opportunity zone outweigh performing an exchange.
All right, Starcatcher, one more question that they have. Thanks for answering. Is it true DSTs only sell when there is a profit? Does appreciation come into play?
The DST properties certainly can and often do appreciate. I mean, all of the appreciation derived from the property has to be distributed to the investors. The firm that acquires the property, structures the trust, manages the investment, and then ultimately sells it. They're what we refer to as the DST sponsor. They're actually not legally allowed to participate in the appreciation as required by the IRS. So all of that ends up flowing through to the investors. But as to whether or not the sponsors will only sell properties when there's been appreciation, that's not always the case. There can be situations where a sponsor may decide to sell a property from a defensive posture. Say they're looking at, in a multifamily situation, the rent starting to plateau with new construction permitted and underway, and now more competition for the property. So looking out over the next 2-3 years, they might be saying this would be a better time to sell than potentially having to hold through 5, 6, 7 years additional time for all that absorption to occur. So they could. It doesn't happen often. We have a very strong track record in terms of the offerings, the properties that have made it through our due diligence process and the returns that clients have experienced. But there's nothing that states that the sponsor has to hold on to the property until there's appreciation. Now they want that because they want to have a good track record as well, and they want repeat investors.
All right, here's Brendan. How much, if any, stake does the DST sponsor typically carry in subject properties?
It's going to depend on the sponsor, but we will see some retain no interest in the property in terms of actual underlying equity ownership, although their compensation structure is weighted heavily toward performance of the property. And then we'll see some sponsors that will take up to a 10% interest in the property and retain that. Whether directly on the principal's books or whether it's held in a REIT that the sponsor manages and owns themselves as well. So somewhere in between that range, but the lion's share of the equity is opened up for exchangers to ultimately invest in and own.
All right, here's Jim on YouTube. How long before you can live in exchange property as a primary residency?
The general rule of thumb there is a year would be adequate. Some would say 2. Some would say if your plan was to own it as an investment property, but something changed circumstantially, but your plan was to own it as an investment property, well, then you satisfied the intent requirement, and there is no limitation on how long it needs.
Work with someone who's in San Diego.
Well, I was in San Diego last week,
Okay.
Wednesday through Friday. So it was nice to get down there, and probably had one of the best burritos of my life down there too, which is usually the case when visiting San Diego. We do have an office in San Francisco, an office in Portland. We have an office in Seattle. The reality is the vast majority, all of the work that we do can be conducted over the phone, email, video conferencing. Easily 80% of our clients, we don't end up having a face-to-face meeting with. Now, if that's something that's important to the client, we're happy to accommodate. The work that we do is relationship based in part. There needs to be trust. I understand that. And then also they're large financial decisions. So if that is something that's necessary for an owner or a client of ours to feel comfortable, absolutely. We'll meet you where we need to meet you for that.
Great. And you'll go to Hawaii too, right?
Certainly. Yeah.
Here we go. Okay, Patricia. If portions of properties are gifted or small amounts are gifted to reduce control in properties to address federal taxes exemption reductions, will those gifts be taxed?
No, because that federal, it depends on the size of the gifts, but that federal exemption amount, that's often referred to as a lifetime giving exclusion. And what that means is that, say it's $5 million, just for a simple number. That's all of your giving that occurs throughout your life in excess of $15,000 per recipient per year. So for example, if I gave my child $25,000 worth of cash in a year, only 10,000 of that, 15,000 doesn't count. 10,000 would be counted against my lifetime giving allowance. And you have to track that, and you sum up all of that lifetime giving, and then you deduct that from the $5 million allowance, and what's left is your estate exemption amount. So yes, the gifting of ownership in property, shares of an LLC, for instance, that would be counted for that lifetime giving exemption, but it's not necessarily going to be taxable unless you're giving millions and millions of dollars of ownership over to your children.
All right. And Jim, California clawback in 1031. Do you see it going away or expiring on out-of-state exchanges?
Jim, what do you think? Do you think California is going to do anything to get rid of a potential revenue source for them? No, it's not. They're probably, there's a number of states. There's over 30 states that have that. I think maybe 39 states that have that clawback exemption, that clawback component to their tax code now for exchanges. But California is unquestionably the most aggressive in terms of tracking it and pursuing it. I don't see that changing. If you have a step up in basis, if you own till you pass away, then that does address the clawback at that point, because there's nothing to claw back. There's no gain any longer. But you do still have to continue to file the affidavit for any property exchange out of California for as long as you continue to have tax deferral, and as long as you're alive then too, stating that you've yet to pay capital gains on that, and that there's not any funds that should be clawed back. That's not an overly cumbersome process. I think that if anything, most taxpayers struggle with that because of the principle, because of the concept, than the actual work involved, but they will enforce that.
Great. So Austin Bowlin, Real Estate Transition Solutions. If you missed the beginning of it, thank you so much for everything that you've shared with us and taking the time to answer questions as well. And so yeah, they're our sponsor, so you definitely want to give them a call. They can work anywhere in the country, and they're ready to work with you, as you've heard already. And then also thanks, a shout out to Livable. And if you really want to lock down that kind of, what do you call it, a variable cost with the water, with the utilities, then Livable is definitely a great solution. And they are very familiar with rent control and all the different legalities that go into it in your specific location. And so you could give them a call or reach out to them, and they'll be able to tell you what you can and can't do, and how they could help you with it. And again, remember to renew your membership or get one now before the end of the year so that you can lock in the best price. And let's see. Yeah. Okay. I don't see any more questions. And anything else, Austin, that you want to share with us before we sign off?
Nope. That's everything. And
Okay.
Appreciate the opportunity to join. Jeff, thanks for the good work you do at AOA, and look forward to the next presentation.
Yeah. And so don't forget, guys, next week, we'll learn how to repeal the death tax, because we're going to want to do that here in the state of California. And subscribe. If you go on the AOAUSA.com website, scroll all the way down on the right side, there's a place for you to subscribe to the newsletter if you haven't. If you're an AOA member, you're subscribed already, unless you unsubscribe. So definitely subscribe so that you can register for things. And sometimes we have a prize wheel that we spin. You may get something out of it for free. And also you'll definitely stay informed. And anyway, thanks everybody. And to all the veterans out there, I just want to say thank you for your service and your sacrifice. And we'll see you next time.
Excellent. Take care, everyone.
Okay, thanks.